Hey, Talk Tickers listeners, welcome back to the show. Today, we are taking a deep dive into HCA Healthcare's Q3 2024 earnings call.
Always an interesting one.
It is, right? And,
It affects everybody.
Exactly.
Yeah.
So let's jump into it. We wanted to give you guys all of the key insights from this recent call about HCA, one of the biggest players in the healthcare space.
Absolutely. And it is a behemoth HCA. Just to give folks some context, they are a for-profit healthcare system, a massive one. They've been around since 1968, headquartered in Nashville, Tennessee. So they're dealing with all those kind of, usual healthcare industry pressures,
Sure.
but also facing some unique challenges this quarter.
Yeah, and speaking of challenges, the CEO, Sam Hazen, basically started the call talking about hurricanes.
Hurricanes.
Not just one.
Just one.
Two major hurricanes.
Back to back.
Yeah, slammed right into some of their key communities. Can you imagine?
2 weeks apart.
Oh, my gosh.
Talk about a stressful quarter.
Yeah, I would be freaking out.
Yeah, of course. And the thing is that they have a lot of facilities in hurricane-prone areas.
Makes sense.
So they've had to really think about this. They've developed this approach to disaster preparedness they call the HCA Way.
Okay, so what is the HCA Way? Is that like their secret recipe for dealing with hurricanes?
Well, I wouldn't say it's a secret recipe, but it is a very kind of systematic approach. I think they've just fine-tuned it over years of experience with strong partnerships. For example, he called out HCA Mission Hospital in Asheville, North Carolina. They've been operating nonstop, even with damaged city infrastructure around them after Hurricane Helene.
Oh, wow.
That's dedication.
Yeah, that's really impressive. But I imagine that these hurricanes probably put a little bit of a dent in their financials.
Oh, absolutely a dent. They're estimating Hurricane Helene alone cost them $50 million or $100 million per diluted share just in Q3.
And that's just Helene, right?
That's just Helene.
There's another one.
And get this, they're bracing for $200 to $300 million hit in Q4 from both hurricanes combined.
Oh, my goodness.
That translates to another zero-layer decline, 60 cents to 90 cents per diluted share.
So,
We have to factor that in when we're thinking about these earnings numbers, right?
Okay.
That's a huge...
Unexpected expense.
Yeah, it's like a small hospital's entire yearly budget.
Right. And it's a testament to their core business that they're still projecting growth for the year.
Okay, so let's talk about that core business. Because despite these hurricane hits, right, they still reported really strong Q3 results. Good revenue growth, margins improved, their diluted earnings per share actually jumped 25% to $4.90. How is that even possible after all we just talked about?
A couple of things. One, their volume growth was really broad-based. Across different markets and service lines. We're talking 4.5% increase in both inpatient admissions and adjusted admissions. They saw a 4.6% increase in ER visits.
Well, that makes sense, hurricanes.
Yeah, well, you would think that people would be avoiding hospitals during a hurricane
Right.
emergencies happen.
They also saw solid growth in cardiac procedures, inpatient rehab admissions, and obstetric volumes. So basically, people still need healthcare even amidst all the chaos.
Yeah, it makes sense. So it sounds like things are really good for them. Was everything up? Was there anything that actually declined?
There was one area that dipped a little bit, outpatient surgery.
Right.
That declined by 2%.
Interesting.
However, even with that decline, their revenue in this service line still increased 5%. This was due to what they called higher acuity cases and a favorable payer mix.
Okay, so you're going to have to define those for me. What do higher acuity and payer mix mean?
Good point. Higher acuity just means more complex cases. They required more resources and therefore brought in more revenue.
Yeah.
So think about it like this. Treating a broken arm is going to cost less than, say, open heart surgery.
Sure.
So even though they had fewer outpatient surgeries, the ones they did were more complex.
So they made more money.
More revenue, yes.
Got it. Okay. What about payer mix? What does that mean?
Payer mix refers to the different sources of payment for those healthcare services. So you have private insurance, government programs like Medicare and Medicaid, and then you have some patients who pay out of pocket. So HCA's favorable payer mix in Q3 means that they had a higher proportion of patients with insurance plans that reimburse them at higher rates.
Interesting. Okay, so they kind of made up for that decline in outpatient surgeries with these better reimbursement rates, with these more complex cases.
Exactly.
Got it. So given all this, where does HCA go from here? What are they looking at for the future?
Looking ahead to 2025, Hazen was cautiously optimistic. He's projecting continued volume growth at 3% to 4%. That's actually higher than their typical long-term projections, which are usually around 2% to 3% growth. So it suggests they see continued strong demand for healthcare services.
That's good, especially with everything going on in the economy.
Absolutely. And he thinks this continued growth, combined with what he hopes will be a stable operating environment, should result in earnings growth that meets or even exceeds their long-term targets.
Wow, so they're expecting to do even better than usual despite these hurricanes.
Exactly. And this all takes into account the ongoing impact of the hurricanes, of course. But it highlights a key takeaway here. Even with these massive hurricane challenges, their core business remains strong.
Right, so we've covered the hurricanes, we've covered the financial performance. What else should our listeners know about this call? What are some of the finer details that we need to unpack?
Well, there's a few key things we should discuss. First, let's talk about this whole thing called denial activity.
Okay.
This is a growing concern for all healthcare providers, not just HCA. Essentially, it means insurance companies are getting tougher on approving claims, which can lead to delays in payment, even outright denials.
So hospitals provide the care, and then the insurance companies are like, nope, we're not paying for that.
It's not always that straightforward, but basically, yes. There's a lot of complex rules and regulations around what they will and won't cover, and they're getting stricter.
Yeah.
Which is causing real headaches for these providers.
I bet. So how is HCA dealing with this?
Well, they're not just sitting back and taking it. They've been really proactive in developing strategies to mitigate these denials. They have something they call an integrated revenue cycle, which basically means they're streamlining their billing and collections process to make sure they're meeting all the requirements.
So they're being really careful.
Yeah, being efficient and organized to try to avoid those denials.
Got it. Okay. What else?
Another big topic was this thing called the 2 midnight rule.
Okay.
Now, this is a Medicare regulation that's been causing some confusion and frustration. It basically dictates when a hospital stay can be billed as an inpatient admission versus an outpatient observation stay.
Okay, and why does that matter? Isn't it just like semantics?
Not really, because inpatient admissions are typically reimbursed at a higher rate than outpatient observation stays, so it really has a big impact on a hospital's finances.
So again, it's about money.
It's about the money, right?
Okay. So how does this rule affect HCA?
Well, on the one hand, it's actually contributed to their admission growth, but on the other hand, they're still facing a high percentage of denials from certain payers related to this rule. And to make matters worse, these denials often lead to delays in discharge. The patients end up staying in the hospital longer than medically necessary because the insurance company is dragging their feet on approving the level of care.
That sounds like a nightmare.
It can be. It drives up costs for hospitals like HCA, creates inefficiency in the system. So, yeah, not ideal.
Okay, so we've got denials and then we've got these rules. Anything else?
Yes. Well, we have to touch on pricing and reimbursement. This is always a complex topic in healthcare, and there are a lot of factors at play for HCA as they head into 2025. You know, things like that 2 midnight rule we just discussed, Medicaid supplemental payment programs, commercial payer contracting.
So they're trying to balance all of these different payment structures and trying to make sure that they get paid fairly for the care that they provide.
It's a delicate balancing act.
Yeah.
Absolutely.
Okay, and then of course,
And finally,
technology and AI.
you can't forget about that, the hot topic. HCA has been investing really heavily in these areas, and they're starting to see some real positive results.
Yeah, AI is everywhere these days.
It really is. They're using it to improve scheduling, predict patient demand, and streamline their revenue cycle management.
So again, trying to get paid and be more efficient.
Exactly. Working smarter, not harder.
Makes sense.
And they see even bigger potential for AI in the future, not just on the operational side, but also improving that clinical care.
So it'll be interesting to see how that plays out.
Absolutely.
So we've covered a lot of ground here. Hurricanes, financials, payer issues, AI. What's next?
Well, we've still got a lot more to unpack in this earnings call. In our next segment, we'll dive deeper into some of those finer details, like the impact of Medicare Advantage, HCA's capital allocation strategy, and their approach to mergers and acquisitions.
Okay, sounds good. So stay tuned, Talk Tickers listeners. We'll be right back after a quick break. Welcome back, Talk Tickers listeners. Let's jump right back into our deep dive on HCA Healthcare's Q3 2024 earnings call. Before the break, we were talking about all those challenges HCA is facing, like payer denials and that confusing two-midnight rule.
Right, and you have to remember that these issues aren't unique to HCA. They're really impacting the entire healthcare industry.
That's a good point. So let's maybe dig a little deeper into some of those, starting with the payer landscape.
Okay, so HCA's CFO, Mike Marks, he gave some really interesting context about how that payer mix is changing. We were talking about payer mix earlier.
Yeah, basically who's paying for it?
Who's paying for the healthcare services? He pointed out that Medicare Advantage now represents a whopping 58% of their total Medicare volume.
58%.
58%.
Wow. So more than half of their Medicare patients are on these Medicare Advantage plans.
Right, and these plans tend to have, different rules and reimbursement rates compared to traditional Medicare, and they often have a higher ratio of observation stays to inpatient admissions.
Okay, remind me again, what's the difference between an observation stay and an inpatient admission? Because it seems like the patients are still in the hospital either way.
It's all about the level of care and how it's billed. Inpatient admission means the patient needs a higher level of care, and the hospital stay is expected to last longer.
Okay.
Observation stays are more for kind of when a patient needs monitoring, but might not require that full inpatient admission.
Okay, got it. So more Medicare Advantage patients could mean more of those observation stays, which aren't as profitable for HCA.
Exactly. And Marks also mentioned that the average length of stay for their Medicare Advantage patients is about 10% longer than for traditional Medicare patients,
Even if they are admitted.
even after adjusting for the types of cases they're seeing.
So they stay longer. Why is that?
He pointed to something called payer-driven discharge delays, which is a fancy way of saying that insurance companies are sometimes slow to approve a patient's discharge, even when the doctor says they're ready to go home.
Oh, I bet that's frustrating.
It is very frustrating.
Why would they do that?
Well, it's complicated, but sometimes they might question the necessity of the inpatient stay or try to push for a lower level of care, which again could mean a lower reimbursement rate for HCA.
So it's a little battle between the hospital and the insurance company, and the patient's kind of stuck in the middle.
And it highlights why HCA is so focused on those denial mitigation strategies we talked about earlier. They're trying to make sure they get paid fairly, especially with these more complex Medicare Advantage cases.
Okay, that makes sense. So we've got this evolving payer landscape, more Medicare Advantage patients, and more potential for denials and delays. What else is HCA doing to kind of navigate this? What about their overall financial strategy?
So they're investing heavily in their future. Their cash flow from operations was a solid $3.5 billion in Q3.
Wow, what are they doing with all that cash?
Putting it to work in several ways. First, they invested $1.19 billion in capital expenditures, basically spending money to upgrade and expand their facilities and equipment.
So making sure that their hospitals are up to date and can handle all of these patients we were talking about?
Absolutely. They also repurchased the significant chunk of their outstanding shares, about $1.79 billion worth.
Okay, hold on. Break that down for me. What does it mean to repurchase shares, and why would they do that?
So it's basically a way for a company to invest in itself. When they repurchase shares, they're reducing the number of shares available in the market,
Okay.
which can increase the value of the remaining shares, which is good for shareholders.
So they're saying, we believe in our company so much, we're going to buy back some of our stock.
Exactly. It's a sign of confidence.
Okay.
They also paid out $169 million in dividends to their shareholders.
Dividends.
Everyone loves a good dividend.
So they're investing in their facilities, buying back shares, paying dividends. Are they going into debt to do all this?
They're managing their debt carefully. One metric they use is something called debt to adjusted EBITDA leverage. It's a way of measuring how much debt they have relative to their earnings.
So the lower the better.
The lower the better, right. And their leverage is currently at the low end of their target range, which means they're not over-leveraged. They also actually lowered their estimated capital expenditures for 2024 to around $5 billion.
Wait, I thought they were all about investing in the future. Why would they lower their spending plans?
It wasn't due to lack of opportunity. They actually clarified that it was mainly due to timing of certain capital projects, likely impacted by, those hurricanes.
Yeah, probably hard to do construction when there's a hurricane.
Exactly.
So they're being flexible?
Shows they're being flexible, adjusting their plans based on these real-world events.
Okay, makes sense. So they're being smart with their money, investing strategically, and keeping that debt in check. Let's switch gears a little bit and talk about the Q&A portion of the call. Where the analysts get to ask management all the tough questions. What stood out to you?
Well, one analyst asked about the slowdown in inpatient revenue per admission they saw in Q3 compared for the first half of the year. Now, this is an important metric because it gives us a sense of their pricing power.
Pricing power meaning their ability to raise prices.
Exactly, to raise prices without losing patients. And the analyst was concerned that this might signal some weakness in their pricing strategy.
But they're still projecting growth, so what's the deal?
Marks explained that this slowdown was mainly due to fluctuations in Medicaid's supplemental payment programs.
Okay, remind us what those are again.
These are programs where states provide additional funding to hospitals that serve a high proportion of Medicaid patients.
Okay, so it's extra money from the government to help hospitals cover the costs of caring for these patients.
Exactly. And these payments can vary from quarter to quarter, which can impact a hospital's revenue per admission.
So it wasn't necessarily a bad thing, it's just these government programs are kind of unpredictable.
Unpredictable, exactly. Shows how external factors can really influence a hospital's financial picture, even if their core business is doing well.
Okay, what else?
Another analyst asked about their volume growth assumptions for 2025, particularly regarding exchange enrollment and Medicaid.
Okay, so those are the Affordable Care Act marketplaces and the government program for low-income individuals.
Right. And those programs have seen a lot of growth lately, so the analyst wanted to know if HCA is expecting that to continue.
Yeah.
Marks said they're expecting that exchange enrollment growth to moderate in 2025, maybe land somewhere between 8% and 10%. Still growth,
That's still good.
but much lower than the 30% surge they saw this year in their markets.
30%.
30%, yeah.
Wow.
He also expects Medicaid volumes to stabilize in 2025 as the effects of the redetermination process kind of fade.
Redetermination, what's that?
Remember how Medicaid enrollment surged during the pandemic?
Yeah, because states weren't allowed to kick people off.
Exactly. Even if they no longer qualified because they wanted to make sure everyone had coverage during the crisis.
Right, and now they're going back and checking.
Now they're going back and checking.
Okay.
Redetermining eligibility, which means some people are losing coverage. And HCA expects that decline to level off in 2025, leading to, more stable Medicaid volumes for them.
Okay, so they're being very realistic, very data-driven,
Right.
right? They're not just assuming that recent trends are going to continue forever.
They're considering all these different factors to make some informed projections about the future.
Yeah.
It's a complicated picture.
Speaking of complicated pictures, we can't forget about those hurricanes. And one analyst actually asked about that. You know how these recent storms might impact their long-term strategy, especially regarding capital allocation and M&A? So will they shy away from hurricane-prone areas or will they double down?
That's a good question. What did they say?
What did they say?
So Hazen was very clear. Their commitment to these regions has not changed. They actually see these areas as essential to their growth strategy, and they've learned some valuable lessons from past hurricanes.
So they're not running away, they're embracing it.
They've invested in making their facilities more resilient, and they've, honed their disaster preparedness capabilities.
It's a risk, but they're willing to take it.
It's a calculated risk.
They're committed.
They're committed long-term vision.
Yeah, they're not just fair weather friends. They're there when times are tough.
Absolutely. And that really is a testament to their long-term vision and their commitment to providing healthcare no matter what happens.
Yeah, so we've covered a ton of ground here, but we are not done yet. Stay with us, Talk Tickers listeners. We are going to be right back after a quick break, and we will dive into HCA's investments in technology and AI, and their approach to value-based care and much more. And we are back, Talk Tickers listeners, ready to wrap up our deep dive into HCA Healthcare's Q3 2024 earnings call. Before the break, we were talking about, HCA's commitment to these hurricane-prone regions and how they're kind of strategically managing that risk.
Yeah, they're definitely taking that long-term view, not just reacting to the short-term challenges.
Right. And it seems like that long-term view is really driving a lot of their decisions, especially when it comes to their investments in technology and AI. We talked earlier about, how they're using AI to improve efficiency, streamline processes.
Yeah, and during the Q&A, an analyst asked specifically about the progress of their resiliency program,
Oh, right.
which aims to find cost savings and optimize operations. They're targeting like $600 to $800 million in savings through this program.
That's a lot of money. What are they doing to achieve that?
Well, focusing on a lot of different areas, reducing supply costs, streamlining staffing, and optimizing their use of technology.
So working smarter, not harder.
Exactly. And the interesting thing is they're not just pocketing those savings, they're reinvesting a lot of that back into key initiatives like their tech and innovation programs.
So using efficiency gains to fuel future growth.
Exactly. It's a smart strategy, and it ties back to what we were discussing earlier about those investments in AI. They're seeing real results from that, not just in terms of cost savings, but, also in improving patient care.
Right. They're using it to predict patient demand, optimize staffing levels, even personalized treatments.
It's amazing to see how technology is transforming healthcare.
It really is. And HCA seems to be leading the way.
Absolutely.
So, shifting gears a little bit, healthcare affordability. This is a concern for everyone these days. One analyst asked about the role of value-based care in their commercial contracts.
Value-based care.
Yeah, can you break that down for us? What is it and how does it relate to affordability?
So value-based care is this healthcare model that focuses on paying for the quality of care rather than the quantity of services.
Okay.
It's often contrasted with the traditional fee-for-service model, where, providers get paid for each test, procedure, visit, regardless of the outcome.
So it's about keeping people healthy, not just treating them when they're sick.
Exactly. And the idea is that this can help lower healthcare costs in the long run, right? Preventing unnecessary tests and procedures and keeping people out of the hospital.
Makes sense.
Yeah.
So is HCA embracing this model?
They are, but it's still a relatively small part of their overall business. Hazen mentioned that, they have some contracts with modest provisions related to quality metrics, but most of their agreements are still based on that traditional fee-for-service model.
So they're dipping their toes in, but not ready to dive in head first.
Yeah, good way to put it. They see value-based care as an important part of the future of healthcare, but they're also realistic about the challenges of transitioning to this new model.
It's complicated.
Very complicated.
Okay, so we've covered efficiency, technology, value-based care. Anything else we need to touch on before we wrap up?
I think we've hit the main points. Overall, this earnings call paints a picture of a company that's navigating a complex and challenging environment, but doing so with a clear strategy, a commitment to long-term growth.
Yeah, they're facing those headwinds from hurricanes, payer pressures, rising costs, but they're also seeing opportunities to innovate, expand, and improve patient care.
They're investing strategically, managing their finances well, and adapting to those industry shifts.
It's really fascinating to see how they're using technology and partnerships to kind of address these challenges and shape the future of healthcare.
It's a company worth watching, that's for sure.
Absolutely. Well, Talk Tickers listeners, that wraps up our deep dive into HCA Healthcare's Q3 2024 earnings call. We hope you found this analysis helpful and informative.
As always, knowledge is power, especially when it comes to investing. So stay informed, stay curious, and we will see you next time for another deep dive.
Happy investing, everyone.